60, 70, 80, 90-year amortizations are what Canadian mortgage borrowers are seeing right now due to skyrocketing interest rates. And what response does the banking regulators OSFI have? They're going to tighten the guidelines to reduce systemic risk. What are they doing? I'm going to explain all of that on this week's reaction video. Now, if you're looking for some help on how to navigate the real estate market in the Greater Toronto Area, you can book a call with me using the link that's on the screen. It's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making awesome educational real estate content just like this one for you. And if you're enjoying some of the content I'm putting out there, make sure you spread the knowledge by smashing the like button and subscribing to the Prime Props channel. And the first article we have for this week is lenders now seeing 60, 70, even 90-year mortgages as Canadians struggle with skyrocketing interest rates. Again, bravo to Toronto Star editor. So what they're basically saying right now, and this is not new to anyone who's been watching the channel, they're saying that because the rates are higher, a lot of people are having these variable mortgages where the payments don't move. So again, this is all the major banks. So you got your BMOs, CIBC, Royal Bank, and also, who am I forgetting? Oh, TD. So basically all the big guys except for Scotiabank, their payments haven't changed, but the payment now barely covers any interest, right? So now we're seeing a lot of people where the amortizations, because they haven't been paying down any principal, actually go to 90 a year. And most people who are going to be affected this, and they will get to that infinite point at some way, shape, or form, are probably people who got mortgages at those banks, like I told you, with a variable between Q4 2021 and Q1 2022. So call it October, November, December of 2021 and January, February 2022. So you got 5 months of actually paying down the mortgage at that lower interest rate before we start seeing the rates hike all the way up until fall of 2022, right? So that's kind of what we're going to be seeing on that. Now, what they're saying here is that the major banks aren't giving these 90-year mortgages out when people are buying their first home. It's just that it's changing it because of the type of mortgages that they have. And they're not extending it by choice. It's just that how the product works. It's contractually how it's set up, right? These are just the products that they have. Now, this is what they're saying, and we've said this many times before. Once a homeowner hits the trigger rate, it's unlikely the amortization to extend unless it's an exceptional circumstances. And I highlighted this because I've heard many circumstances where people have gotten their amortizations extended, or they've been changed because of these circumstances actually quite easily, right? They just declare financial hardship. And even in the federal budget, there's a very strict line item that came out that says the banks will go help a lot of these homeowners who are in these circumstances, right? So again, it's a bailout, backstop, whatever, right? For a lot of homeowners, because remember, the banks want the homeowners to continue paying so that they're still making money. And the liability is actually on the bank because they're going to own this underwater asset. So they actually want the homeowners to continue paying these interest rates. So this is why I'm saying OSFI and the banks are going to be clashing right now. And that's why there's these exceptional circumstances. I think they're going to be happening more often than not. They're just not being broadcasted out everywhere. I already know more than a handful that have got these exceptional circumstances. Now, these lengthy amortizations have recently come under scrutiny by Canada's banking regulator, which is OSFI, right? And they basically told the banks to get it in order and that on renewal, it must go back to initial amortization. Look, this is, I would say, a warning, because one of the things that they basically did right here is that they tightened the guidelines on combined loan plans. And I'll explain what that is a little bit, to reduce systemic risk. So this is not necessarily like their response to amortization, but this is what I'm calling out OSFI for saying, look, you guys are doing well, but there's a lot of talk about doing things, and talk is cheap. I need to see actions. And I haven't seen any actions about these amortizations being changed. Now, this article is referencing this release that came out last week. I'll basically explain it to you. So a combined loan plan is basically where two mortgages are put together. It's a very common one you're probably going to be seeing is like if you got a mortgage and then they tacked on a HELOC, right? A home equity line of credit attached to it, right? Especially if it's revolving or readvanceable, meaning that every time you pay off some principal, you get a larger line of credit, which is ironic because if you're negative amortizing, you should be getting none of it. Anyways, thought for a different day, right? So that's what they're kind of clamping down on. And what they're saying right now is that the most significant concern of these products, the CLPs that I'm talking about, so the HELOCs mixed with mortgages is that the credit above 65% loan to value, meaning that if you had $1 million property, that the total combination of these two things is greater than 65% of the value is. So in the $1 million example, you're at $650,000, right? So what they're basically saying now is for those who owe more than 65% loan to value, meaning people who have two mortgages greater than the original amount. So if when you got your mortgage, say it's $1 million, even though the market value could be like $900,000 right now, originally if it's $1 million and you have more than 650 attached with this readvanceable loan, that's where the risk is. And that a portion of the principal will go towards reducing your overall line of credit, meaning pay back that loan amount. So anyone who kind of say has a mortgage right now, right? They're paying it down and they have more than 65% of the line of credit drawn out. Your principal that you're paying down towards the mortgage is going to go back to paying the line of credit, meaning that you're reducing the amount of debt that's out there. But it's just fine, right? I mean, systemic risk, subjective, but yeah, it's fine, okay? And that this typically will happen to the next time the borrowers renew their amount at the end of October or December, depending on the fiscal year of the bank. Meaning that this is coming up and anyone who's renewing these mortgages, this is going to be in effect at the end of this year. But at the moment right now, it's not a snap of a finger, it's changing right now. So here are the things that they have as quick facts. They're saying that basically no monthly payment increases are going to change, meaning again, no stress on anyone who has this type of product and is, being at risk of having this change on them when they renew. So again, not much of an effect on the market. And then as of 2022 in March, CLPs above 65% loan to value account for $204 billion with a B of the $1.8 trillion with a T of outstanding residential mortgages as of Bank of Canada. So what this means is like 11% of the people use more than 65% of their home equity line of credits, HELOC. Let's say they've used to buy another property right now, right? So those are the people I would say are probably maybe the pre-construction buyers and they use it to pay off a deposit or they just buy off the whole thing. And they need to take any of their primary residence mortgage that they borrowed against from and has to go and cover the line of credit to reduce it below 65%. So it's basically not changing anyone's bottom line, but they're just reducing the amount of kind of debt out there. Is this going to ultimately affect the market? No. If this was OSFI's response to tightening it, sure, they're tightening the regulation, meaning preventing people from using borrowed funds to buy more properties. I think it's a little bit too late already. Even when this comes into effect, I don't think it's going to affect the market too much because I don't think anyone's borrowing funds from their primary residence to buy another investment property right now. So again, I think small effect, right? Very small effect. So at the bottom here, there's a couple of quotes I highlighted. So an economist at Royal Bank says, while this number is far from negligible, meaning the amount of debt outstanding. So they say here, the $204 billion of $1.8 trillion, again, 11%. Not everyone with those types of products will be affected. See what I mean? So you have to be kind of like that Venn diagram of having a line of credit from the bank and you're over 65% and your mortgage payment is actually paying that back off. And not all banks will, unless you're negative amortizing, will have that affected, right? So it's very, very small fractional amount of people that's going to be affected. And this is what I'm saying, a lot of talk from the banking regulators, not enough action right now for fixing these amortizations. So, yeah. And there's another person here that says, I can't stress enough, this is an immaterial mortgage rule change as the housing industry could possibly hope for. Meaning again, all talk, no reaction. And it said that if the borrowers want the type of readvanceable mortgage available today, odds are they're going to be able to go to a non-federally regulated lenders, which are credit unions, right? Where they could get a fully revolving HELOC up to 80% instead of the limit of 65% at the banks. So this is what I've been saying. A lot of these things are made to look like they're doing stuff and clamping down, but really they're not. And I've even had emails and people reach out to me where non-banking regulators, they're doing amortization of 50 years already, right? So there's a lot of creative products out there for people who are kind of stretched. And I think some of it is predatory, some of it is not. So again, if you're in that position, just be careful. But I would say because there's so much time and so much kind of attention drawn upon this, and the amount of people who actually are negative amortizing and maybe just kind of chilling and waiting and they'll pay back later, at least from what I hear talking to a lot of my clients, at least very small circle base, right? Of kind of relative to the entire market. I don't think this 2025, 2026 renewal is going to be that big of a disaster as much as people think. But again, if you think you're going to be in that situation where it could be disastrous, you have time right now between 2025 and 2026 to actually fix it, right? So there's a lot of time. Like I wouldn't hope and pray interest rates come down or prices kind of ramp back up, given that we just had a surprise rate hike in June and we may have one next week or the following week in July. You should still fix what your issue and get a plan A and a plan B ready. But that doesn't mean that, you know, the world is going to fall apart in 2-3 years, because we still have that much time to kind of fix a lot of these issues. And while it's a very big component of a lot of like the banks outside of Scotia's kind of mortgage book, I don't really think it's going to be that big of a deal because we have time to fix it. Now, can my opinion change when we come to like end of 2024 or like say 18 months or so? Yeah, absolutely, right? But the moment right now, it doesn't feel overly dramatic. I mean, some people are feeling it, but I don't think the world's going to crash and the market's going to crash at any point right now in 2025 or 2026 because, again, people have time to fix it. Anyways, hope this gives you an idea of what's happening in the real estate market. We're going to be going to like the dog days of summer where like things are a little bit slower, hopefully, right? Given that we have a surprise rate hike and we may have another one in July. Everyone's basically going to be watching the interest rate announcement in middle of July and what the CPI numbers are. So thankfully we had a lower CPI print, but the irony of the CPI print is that the interest rate itself is inflationary. So if you think about that, the interest rates are inflationary because they're tacking on so much of the CPI from shelter costs, which is just wild if you think about it. Anyways, hope this gives you an idea of what's going on. And if you are looking for some help on how to navigate this real estate market, you can book a call with me using the link that's right here, www.chatwithzen.com. Until next time, your move, your future. See ya. Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?